Value investing is a proven strategy that has stood the test of time. It was popularized by legendary investors like Benjamin Graham and Warren Buffett, who have demonstrated its effectiveness through decades of market cycles. The core principle of value investing is to buy stocks that are undervalued by the market. This means purchasing shares at a price lower than their intrinsic value, which is determined through detailed financial analysis and understanding of the company's fundamentals. It focuses on identifying undervalued assets that have the potential to grow over time. These assets are often overlooked by the market due to temporary issues or market inefficiencies. Value investors look for companies with strong fundamentals, such as solid earnings, robust cash flow, and a competitive edge in their industry. They believe that the market will eventually recognize the true value of these assets, leading to significant price appreciation. These assets are priced below their intrinsic worth, providing a margin of safety for investors. This margin of safety is crucial because it reduces the risk of loss and increases the potential for gain. By buying undervalued stocks, investors can protect themselves against market volatility and downturns. This approach requires a deep understanding of financial statements, industry trends, and economic factors that can impact a company's performance. Patience is paramount in this approach. Value investing is not about making quick profits. It's about building wealth over the long term. Investors must be willing to hold on to their investments for years, sometimes even decades, to realize their full potential. This requires a calm and disciplined mindset, as well as the ability to stay focused on the long-term goals despite short-term market fluctuations. It helps investors weather market fluctuations and avoid making impulsive decisions based on short-term market movements. By maintaining a long-term perspective, value investors can stay committed to their investment strategy and avoid the pitfalls of market timing. This approach also allows them to take advantage of market downturns by buying more undervalued stocks at lower prices. It allows them to make rational decisions based on thorough analysis and careful consideration of the facts. This analytical approach helps investors to stay objective and avoid emotional reactions to market events. By focusing on the intrinsic value of the assets, they can make informed decisions that are aligned with their long-term investment goals. Patience is not simply waiting, it's an active process. Investors must continuously research and stay informed about the companies they invest in. This involves reading financial reports, staying updated on industry trends, and monitoring economic indicators that can affect the market. Continuous learning and staying informed are essential components of successful value investing. They need to learn about market trends, economic cycles, and the factors that can influence stock prices. This knowledge helps them to make better investment decisions and to identify new opportunities for growth. Attending financial seminars, reading books, and following market news are all part of the ongoing education process for value investors. This continuous learning is key to success. It enables investors to adapt to changing market conditions and to refine their investment strategies over time. By staying informed and educated, value investors can improve their ability to identify undervalued assets and to make sound investment decisions. Value investing requires a long-term perspective. It demands emotional discipline and the ability to stay focused on the big picture. Investors must be able to look beyond short-term market noise and to remain committed to their investment strategy. This long-term approach helps them to build wealth gradually and to achieve their financial goals. By embracing patience, investors can unlock significant returns. The rewards of value investing are not immediate, but they can be substantial over time. Investors who are patient and disciplined can achieve impressive financial results and build a secure financial future. They can achieve their financial goals and enjoy the benefits of their hard work and dedication. Value investing is a journey that requires patience, discipline, and continuous learning, but the rewards are well worth the effort. Market cycles are a fundamental aspect of investing. Just like the ocean, markets ebb and flow. They experience periods of growth and contraction. Understanding these cycles is crucial for value investors. During market booms, prices rise rapidly. Investors become euphoric. However, these periods are often followed by corrections or downturns. This is where patience becomes essential. Patient investors can withstand these downturns. They recognize them as buying opportunities. By acquiring assets at discounted prices, they position themselves for future gains. Thorough research is non-negotiable in value investing. Patience plays a crucial role in this process. It allows investors to delve deep into a company's fundamentals. It helps them understand its true worth. Investors must analyze financial statements. They need to evaluate management quality. They must assess competitive advantages. This due diligence takes time. It requires patience. Rushing into an investment without proper research is risky. Patience allows investors to make informed decisions. It helps them avoid costly mistakes. The financial world is noisy. It's filled with daily market fluctuations. News headlines can be misleading. They often create unnecessary panic or excitement. Value investors must tune out this noise. They need to focus on the long-term fundamentals. Patience is their shield against short-term distractions. By maintaining a long-term perspective, investors can avoid impulsive decisions. They can stay the course even when the market gets turbulent. Section 5. Emotional Mastery, the investor's secret weapon. Investing is not just about numbers, it's also about emotions. The ability to manage one's emotions can be the difference between success and failure in the investment world. Fear and greed can cloud judgment. These powerful emotions can lead investors to make impulsive decisions that they later regret. They can lead to poor decisions, such as selling off stocks in a panic or buying into a bubble. Patience is the key to emotional discipline. By taking a step back and analyzing the situation calmly, investors can avoid making rash decisions. It helps investors control their impulses. Techniques such as deep breathing, meditation, and mindfulness can be incredibly effective in maintaining emotional balance. It allows them to make rational choices based on logic, not fear. Consulting with a financial advisor can also provide a more objective perspective. Building emotional resilience takes time. It requires practice. Regularly engaging in activities that promote mental well-being can strengthen an investor's ability to stay calm under pressure, but the rewards are significant. Investors who master their emotions are more likely to see long-term success and achieve their financial goals. Patient investors are better equipped to handle market volatility. They understand that market fluctuations are a normal part of investing and are less likely to react impulsively. They are more likely to achieve their financial goals. By maintaining emotional discipline, investors can navigate the ups and downs of the market with confidence and poise. Section 6. Case Studies, the Triumph of Patience in Action. History is replete with examples of patient investors who achieved extraordinary returns. Warren Buffett, the Oracle of Omaha, is a prime example. Buffett's investment philosophy centers around patience. He famously said, "The stock market is a device for transferring money from the impatient to the patient." Another example is Charlie Munger, Buffett's longtime business partner. Munger's investment approach also emphasizes patience. He believes that waiting for the right opportunity is crucial for success. Section 7. Cultivating Patience, a practical guide for the value investor. Cultivating patience takes effort. It requires conscious practice. Patience is not just a virtue, but a critical skill for value investors. It allows you to weather the ups and downs of the market without making hasty decisions that could jeopardize your long-term goals. Here are some practical tips for value investors. First, define your investment strategy. This means understanding your financial goals, risk tolerance, and the types of investments that align with your objectives. Write down your strategy and refer to it often. Having a clear plan helps you stay focused and avoid impulsive decisions. It acts as a roadmap, guiding you through the complexities of the market. When you have a plan, you're less likely to be swayed by short-term market movements or sensational news headlines. Second, avoid constant portfolio checking. While it's important to stay informed, obsessively monitoring your portfolio can lead to emotional reactions. These reactions often result in buying high and selling low, which is the opposite of what you want to achieve. Instead, set specific times to review your investments, such as quarterly or semi-annually. This approach helps you maintain a long-term perspective and reduces the stress associated with daily market fluctuations. Third, embrace market volatility. Understand that market fluctuations are normal. Don't panic during downturns. Instead, view them as opportunities to buy quality stocks at a discount. Remember, the market has historically trended upwards over the long term. By maintaining a calm and rational mindset, you can make better investment decisions. Educate yourself about market cycles and the factors that drive them. This knowledge will give you the confidence to stay the course even when the market is turbulent. By incorporating these practices, investors can develop the patience needed for long-term success. Patience, combined with a well-thought-out strategy and a disciplined approach, can significantly enhance your investment outcomes. Stay committed to your plan, and over time, you'll likely see the rewards of your patience and diligence. Section 8. Conclusion. Embracing the long game. In the world of investing, patience is not just a virtue, it's a competitive advantage. It allows value investors to navigate market cycles. It helps them make sound decisions. Patience is the cornerstone of long-term success. By embracing this powerful principle, investors can unlock their financial potential. They can achieve their financial dreams. Remember, investing is a marathon, not a sprint. Stay patient, stay focused, and the rewards will follow.